I know, nobody wants to talk about them, but hang tight for the next segment, because before you file those taxes, we're talking to an insider, an expert, who's going to give us some tips on expenses that you can deduct that you might not have known about.
Well, I hate to bring it up, 2 months until tax day, and while that may seem like a lot of time, it's never too early to start thinking about it. And today, CPA Bob Hockensmith is here with some tax deductions that maybe you didn't think about. Good morning.
How you doing, Scott?
Good, good. So what would that be that we haven't thought about?
Here's a couple that people don't even think about, right? And we make jokes about it sometimes when we're watching the games. If you are a professional athlete, for instance, and they get fined, like when Marshawn Lynch gets fined, his fines are actually a tax deduction.
Oh, come on.
So when some of these athletes get fined, you hear about it, we sort of chuckle in our industry because they're going, well, there's a tax deduction for them.
Wow.
They actually get to write that off on their schedule.
I was reading through this, and correct me if this is not true. You can write off your gambling losses?
Yes, you can write off gambling losses equal to gambling winnings. So you have to win something to be able to get a tax deduction. And this is important because I have clients that play the lottery all the time. They don't win, they throw away the ticket. I tell my clients, keep those tickets, because what happens if you win in December and you have no proof of what you played all year long?
Okay, so you have to win something to write off that.
Equal to your winnings. So you keep the tickets until the end of the year. If you didn't win anything, then you can throw them away.
Okay, so, okay. So if I lost a lot of money playing Powerball, I never won, but I maybe won $2. That's
well, it doesn't matter. It's not enough to worry about.
All right.
Here's one that a lot of people aren't aware of that would affect a great number of people, and that is legal fees if you're having issues with alimony. Let's say you're in an alimony dispute, with your spouse or ex-spouse. The legal fees you pay for that dispute is a tax deduction, and a lot of people are not aware those legal fees are deductible.
And then I'm also reading that if you get caught up in a Ponzi scheme or something like you can lose some money, you can write that off?
Absolutely. Now, Bernie Madoff stole over $150 million to Americans, right?
Right.
We found that we could write that off 100% against your income. And that's a biggie because a lot of people lost their life savings, which means that they won't pay taxes for years and years and years to come.
Oh my gosh. Yeah. So we've been reporting that the IRS has fewer employees this year, less audits. Is that significant?
It is absolutely significant, because what we're going to find is that more people become a little bit more aggressive. They say, well, let me gamble, let me take a chance here and take a deduction that perhaps I really shouldn't take. And then when they do get it, the IRS is always 2 years behind, and they do it for a number of reasons. But 2 years later, when they catch you, you're going to have to pay the extra tax, pay the extra penalty, and pay the interest on the tax and the penalty. So it really doesn't make sense to do that.
Who gets audited, by the way?
People who get audited are people who take high deductions compared to their income. There's actually 3 different ways that the IRS picks for audit. One's called a DIF score, discriminant income factor. It's like a golf score. You want your golf score to be low, and therefore you want your DIF score to be low. So if you take high deductions, high mortgage deductions, and you're only earning $30,000 a year.
And you live in a $2 million house.
Right. They're going to go, wait a minute, that doesn't make sense.
Okay. Yeah. All right. And what are the other 2?
Well, the other, random. Actually, random is one way that can happen. And the third way, ironically, is when somebody reports you. An ex-spouse, an ex-boyfriend or girlfriend, and somebody reports you.
Ouch.
Yeah. But what people don't know is that when you report someone to the IRS, guess what? You get audited as much as that person gets audited.
That's interesting.
Big surprise.
Some other things that we should keep in mind heading into this tax season.
Well, this year you want to take advantage of the medical expenses, because while medical expenses may not be deductible to the federal government because they have to exceed 7.5% of your income or 10% of your income, the state medical expenses are 100% deductible. And a lot of Arizonans don't think of that, so they don't keep the receipts and they lose a big deduction on their state tax return. We
were also talking a couple of weeks ago about people who still file through the mail. I mean, that's old school. That takes forever, doesn't it?
It does, yeah. I mean, if you file your tax return by paper, you're looking at 3 months before you get your refund. And if your refund is $10,000 or more, you're looking at 6 to 9 months before you get your refund now. So electronic is the way to go.
That is a long time. Bob, thank you so much. We appreciate it.
You bet, Scott.
It's always fun talking to you about this stuff, even though we hate taxes.
I know, yeah.